Just taking a step back, if the lead into the conversation was around WeWork, I'll give you a twist to that today, which is Datadog, I think, lifted the price on its offering. And so I do think you are seeing strong technology companies with strong go-to-market, good revenue growth. Datadog, I think, was 100% year-on-year revenue growth last year. For the first half of this past year is about 86% growth or so. So you're seeing strong revenue growth, good opportunity for profitability. So I do think for SaaS software companies, there's still a long runway ahead. You look at Zoom's another great example of a company that I think has performed well on the metrics, even though the market hasn't responded yet.
Chamath, what do you think about what Costello said?
About 2 years ago, I started to take a really hard look at private market investing and made a very difficult decision to basically do fewer deals and much more concentrated investments. And the reason is because I just saw the rates of return in private investing decaying very rapidly. Just to give you an example, from 2011 to 2018, had you just invested in the S&P and reinvested dividends, that's almost 16% a year rate of return. And, there was some leaked data yesterday about some very prominent venture funds. And what you saw was their returns were in the low to mid-teens. So you have to ask yourself a question. Why would you block up your money for 10 plus years in a very turbulent private market investing ecosystem to generate 2/3 of the return of a highly liquid public stock market index? I think the answer is you wouldn't. And so, what it says is that private investing is difficult. Generating superior rates of return have always been difficult, but even now, because there's so much more money at play, valuations are out of control. From my perspective, it was pretty clear that the best days were probably behind us, and you had to be much more selective and much more concentrated if you were going to have a chance of generating a reasonable rate of return.
Hey, Adam, I laughed at your elevated consciousness joke. I know you don't have a studio audience out there, but we thought it was funny here.
That's Josh Brown for you, Adam.
I wanted to, and I wish I could see the kicks today, Adam, that we're cut off at the bottom. So I wanted to ask you guys about something that Chamath mentioned, which is too much money. And to me, that's the root of the issue. I don't think Adam Neumann would have gotten as far as he did if you didn't have an entity like the Vision Fund using Saudi money to basically bid themselves up. They invest at $10 billion, then they invest again at $20 billion, and they say, look, we're up 100% on our WeWork investment. If you don't have dumb money coming from, let's say, pensions, making their first ever venture investments, and all of these big pools of capital from sovereign wealth, if that money doesn't exist, then nobody gets enabled to the point where they can resell the name of the company back to the shareholders for $6 million or lease their own buildings to, I think all of those abuses stem from this idea that there's just too much money. Do you guys agree, though, that it's mostly due to the fact that everyone is looking in the rearview mirror and they're saying, well, we need to hit this 9% bogey and we're not going to raise taxes or anything, so the investment fund has to do it. Where can we get that? Oh, look, private equity 10-year returns, venture capital 10-year returns. And so that's what's enabling and driving all of this money into these conversations about, first round, second round. What do you think about that?
I want to be clear, a lot of these 10-year returns are actually still not realized. The great fallacy about all of this is that all of these are paper returns for the most part. This is, the game that one can play with IRR or internal rates of return. And, a very great investor, Bill Gurley, has this great phrase, which is you cannot eat IRR. And, what he's trying to say there is that until the money is realized and in the bank, anybody can make up anything. In the last 5 or 6 years, we have literally quintupled the amount of money going into private company investing from about 20 billion to 100 billion. So the average question would be, well, is the number of outcomes 5x? Is the amount of money and value created 5x? And unfortunately, in the 5-year window, it's improbable that that is the case. And so what you're going to continue to see are paper profits, marked up gains, and funds that very quickly become not about generating profits or realizing profits, but about generating fees by raising new funds. And that's why you have things like SoftBank play out. You have them invest, then you have the parent company able to mark it up. They look like they have huge paper gains. They can then go and raise another fund. I mean, 2% on $100 billion is $2 billion. That's a lot of money per year that you can take off the table. So why wouldn't you do it?
Adam?
Yeah, I will say the other thing that we're seeing in the private space is this incredible barbell on both sides of the equation. The super early stage, you now have so many investment firms that have been fired up to go after early stage. So you see valuations there all of a sudden get very overheated. And now at the ultra late stage, first with the Vision Fund and then all of the follow-on with that, Sequoia, et cetera, raising other large funds to try and match. You now are sitting in a situation where do you find value? At the very early stage, it's overheated. At the very late stage, as we're seeing, is overheated. And I think, it puts the market in the private market in a really peculiar situation. I do think there is an opportunity for this gap in the middle between those two barbells. And it's, when these companies hit product market fit, and they're just starting to scale, it seems like that is the one opportunity that exists right now in private tech markets.